Hello everyone. The Federal Reserve is deliberately pressuring banks to address the ongoing crisis. As a result, stocks of major banks are already plummeting due to the current economic situation. It is crucial for business owners, credit card users, and anyone seeking loans to pay close attention to the hidden happenings behind the scenes. The authorities would rather keep you focused on topics like the Israel-Hamas conflict, the Russia-Ukraine situation, or even the UFC deal with Bud Light sponsorship. They want these distractions to occupy your thoughts while they quietly revolutionize and restructure the entire banking system that we have grown accustomed to. Let me provide you with evidence of what is unfolding. Take a look at the state of Bank of America, Wells Fargo, JP Morgan Chase, and Citigroup. Their stocks are falling rapidly. These facts need to be acknowledged. If you find this information useful, please hit the like button and share this content to raise awareness about what is truly happening in America. Another significant issue is the delicate position that banks find themselves in. The Federal Reserve, instead of addressing the crisis head-on, is capitalizing on the opportunity to implement new regulations and conduct a complete overhaul of the economy. As a result, personal savings rates continue to plummet, exacerbating the overall financial instability. Furthermore, the commercial real estate sector is facing a daunting challenge. In the next year or so, around $1.5 trillion worth of commercial real estate will require refinancing. Given that this is part of a $20 trillion market, this represents a significant proportion that needs to be addressed. Additionally, by 2027, approximately 1 in 10 properties in the country will require refinancing. Traditionally, residential properties, such as 1 to 4 unit buildings, have 30-year fixed loans. However, commercial properties operate differently. They typically have shorter loan terms, ranging from 3 to 7 years. Once this term is over, property owners must return to the bank, where their income is assessed and the property is appraised. Based on these evaluations, the bank decides the future loan amount. A significant portion of the debt and exposure in the U.S. banking system is held by these banks. The Federal Reserve has announced that they plan to keep interest rates high for an extended period, which implies that financial institutions will have to deal with the consequences of this decision. However, there is another development to consider. The Fed has recently revealed its intention to lower swipe fees, which could potentially have a detrimental impact on banks and credit card giants. To provide some background, whenever a credit card is swiped for a transaction, the merchant is required to pay a fee to process the transaction. Currently, a $1.50 transaction would cost the merchant approximately 42 cents. However, the Fed aims to reduce this fee to 17.7 cents, which translates to a nearly 70% reduction in fees charged by banks and credit card companies. On the surface, this might seem like a positive move, especially for consumers who despise these additional charges. Nevertheless, in the context of the ongoing wave of defaults, this decision could create more obstacles. As defaults increase and credit card companies find themselves earning less revenue from lending due to reduced swipe fees, they are likely to become more cautious about granting loans to high-risk individuals. Given the current economic situation in America, where a significant portion of the population can be classified as high risk, this could significantly limit lending opportunities. Consequently, banks and credit card companies would see a decrease in their overall profitability. Simultaneously, the introduction of new banking regulations further threatens the traditional method of operation for regional banks. These banks were once able to independently assess the level of risk they were comfortable with and make lending decisions accordingly. However, under the new rules, banks with assets exceeding $100 billion will no longer possess this autonomy. Instead, they will be required to adhere to standardized risk assessment models, which will impact their capital requirements and restrict their ability to manage risk according to their own guidelines. Overall, the new regulations are expected to transform the way banks operate. Amidst these changes, it is evident that a significant transformation is on the horizon for the banking system. However, another crucial issue that has gone relatively unnoticed is the mounting pressure on U.S. banks to address the financial risks associated with climate change. Under new regulatory activities, these banks will face demands to consider the potential impact of climate change on underserved communities, a matter that has largely been ignored until now. Regulatory expectations dictate that banks with assets exceeding $100 billion must infuse climate risk considerations into all aspects of their operations. This includes board understanding and oversight of the bank's exposure to climate risk, considering climate goals when determining the company's overall business strategy, and exploring tools to measure climate risk exposure. The FDIC board recognizes that climate poses a current financial risk rather than a long-term threat for banks, as demonstrated by recent issues in the insurance industry. The rising premiums and uninsurability of homes due to climate-related challenges highlight the immediate impact climate change can have on lending and property investments. Commercial loans are due. It will become increasingly difficult to secure loans due to rising insurance costs, softening rents, and increasing borrowing costs. This dynamic situation presents an opportunity for cash-rich investors to self-insure properties without needing banks. This potential scenario could create a massive opportunity for investors to acquire properties, particularly institutional investors with large amounts of cash, such as KKR, Blackstone, BlackRock, and Starwood Capital. Additionally, reputable entities like the C40 Network and the World Bank that emphasize the impact of climate change on various industries, including shipping and ports. The implications for banks are highlighted as businesses in these sectors will need to comply with new emissions standards, potentially affecting their lending relationships. Furthermore, as banks suffer losses resulting from climate-related risks, they may adopt more responsible lending practices to protect people's lives and promote a safe and equitable society. In order to mitigate the collapse of the U.S. banking system, it is crucial that we take a more cautious approach towards approving loans and refinancing debts. We must carefully consider who has access to credit and evaluate the risks associated with each individual's financial situation. Although this may seem like an exaggerated scenario, if we connect the dots and pay attention to the statements made by the Federal Reserve, Fed, it becomes evident that this is the path we are heading towards. The process is unfolding rapidly, and astute investors are already preparing for it. It is important to note that the Federal Deposit Insurance Corporation, FDIC, does not dictate client policies or determine which clients deserve assistance. However, financial institutions should carefully assess the financial risks of their clients, just as they assess any other risks, and make credit and investment decisions accordingly. Now let me ask you, what do you think will happen? Personally, I have full confidence that this is the direction we will be moving in. I am willing to bet everything on it. Over the next few years, it will be a slow and painful progression, comparable to a death by 1,000 cuts. If you are a business owner or a professional in the field, I urge you to seriously consider these facts. Smart individuals make informed decisions based on concrete evidence, whereas others choose to ignore the facts and rely on their emotions. The truth is that this collapse is imminent, and it's crucial to position yourself accordingly. To do so, ensure that you have access to funds because most individuals will not. By securing your financial position, you will be able to stay ahead while others are left wondering what went wrong. Share your thoughts below, and let's engage in a conversation about this topic.